And well, let's talk about the big ripple effect of this entire war. The top question that is doing the rounds in global markets this week is, if oil prices are above $120 per barrel, U.S. gas prices have surged to the highest since August 2022, and the Iran war isn't over yet, why are the stocks near record highs? Let's put that in context. On Thursday this week, benchmark Brent crude extended gains to the highest since 2022, marking over 20% gains for the week so far. It surged past $120 per barrel on Thursday as President Trump rejected Iran's Hormuz proposal. Analysts say that Brent could possibly revisit the 2020 highs of over $140 per barrel if the Hormuz blockade continues. Energy and other supplies through the critical Strait of Hormuz are at a standstill. The war has caused the largest oil supply disruption in history, with roughly 12 million barrels per day removed from the global market. Over 500 million barrels of crude were lost in just 50 days, creating a $50 billion revenue shortfall. That has led to fuel rationing across much of Africa and Asia on the fears of a global economic slowdown. And as a result, the Indian rupee hit a fresh low of 95.27 versus the dollar. U.S. gas prices have spiked 42% since the start of this war, marking the biggest surge that has been seen in 30 years. However, Wall Street stocks have been on a tear since hitting a low on the 30th of March. The S&P 500 has recovered about 10% from its war low, with the market actively pricing out earlier fears of severe war. Benchmarks have taken only 3 weeks to rise from their lows to reach new record highs, essentially recovering all war fuel losses by mid-April. The real question is, why? Well, the answer is simple. The artificial intelligence revolution has simply become so large that investors are now viewing everything else as noise at the moment. The AI narrative has grown even during the war, and as broader market sell-off last month swept tech giants like Nvidia and Alphabet lower, these stocks reached their cheapest valuation level since 2019. Wednesday's earnings reports from Alphabet, Amazon, Meta, and Microsoft all confirmed the AI rhetoric. In fact, Wall Street's so-called Magnificent Seven firms are set to invest over $600 billion in AI this year alone. At the March 30th low, remember, the S&P 500 tech index was trading at just a 4% forward price to earnings premium to the benchmark. That is the lowest and cheapest since January of 2019. Forward price to earnings ratio is a measure to understand the stock's valuation as compared to predicted earnings. The war-led sell-off made tech stocks cheaper than the average S&P 500 stock for the first time since 2017. For example, Nvidia is now trading at just a 26 times forward price to earnings multiple, even as it is back near record highs. By comparison, Walmart is at 43 times and Costco at 46 times. So we're now in the biggest technological revolution of modern history, and even $100 oil and rate cuts priced out until 2027 are unable to derail this rally. Many investors had anticipated a much sharper sell-off, and as this did not happen, money has moved back rapidly into the market to chase the rally. While oil prices are set to rise further from the Iran-US stalemate, current market behavior reflects a belief in technological growth overriding geopolitical risks. At least that is the short-term view. While volatility is expected to remain, bets show the path of at least resistance for stocks is more to the upside. But the stock rally's test, it will, remember, come from how the Dow Jones Index performs. As per analysis by LSEG, a new bullish trend in the stock market must be confirmed by both the Dow Jones Industrial Average and the Dow Jones Transportation Average to be durable. So far, it's an open question. The Dow Jones Index hasn't made a record closing high since February 10th, before the start of the war. For the bull market to be confirmed under the Dow theory, the industrials must surpass their February peak very soon.